Hello again. So this is going to be the homework from chapter 5, and I did something a little different this time, so you don't have to watch me typing, which I'm sure is tedious for you, is I already did the problem, and I'm going to go over it. So this is exercise 7, which is on page 242. And it's a demonstration of the high-low method. All right, so let me read it to you. Mountain Dental Services is a specialized dental practice whose only service is filling cavities. Mountain has recorded the following for the past 9 months. So you see a chart, a table, with a list for each month, the number of cavities filled, and the total cost. So requirement number 1, use the high-low method to estimate the total fixed and variable cost per cavity. So go down that list, look for the high month. The high month was February. They filled 700 cavities, and their total cost was $6,000. The low month was June. They filled 300 cavities at a total cost of $3,200. Now remember what we're trying to do here. We're trying to separate the variable from the fixed. So if I take the difference between the high and the low, 700 minus 300 is 400. 6,000 minus 3,200 is 2,800. If I take 2,800 and divide it by 400, I get $7 a unit. The variable cost is $7 per unit. Now, the example in the textbook, the Starbooks example, it came out to 25 cents a unit, if you remember. So maybe you want to go back and review those pages, and then look at this. So we're going to prove it. We need to prove it for both February and for June. Now, to do that, we want to take the total cost and we want to subtract the variable cost. The variable cost would be the $7 a unit times the 700 cavities filled. That's 4,900. 6,000 minus 4,900 is 1,100. So the total cost is 6,000. The variable cost is 4,900, means the fixed cost is 1,100. We do the same thing for June. For June, the total cost was 3,200. The variable cost is 2,100. $7 per unit times 300 units. The fixed cost is 1,100, right? So we get 1,100 here and 1,100 here. The fixed cost is 1,100. Now, the second part of the problem says, using these estimates, calculate Mountain's total cost for filling 500 cavities. Well, 500 cavities, the variable cost would be $7 per cavity times 500 is 3,500. The fixed cost is 1,100, right? 1,100. Total is 4,600. Now, there's another part of the problem in the textbook that I don't think you have to answer on Connect, but there's a part 3 that says, how close does your estimate match the actual for March? Now, if you look at the chart on page 242, 500 cavities were filled in March, and the total cost was 4,500. Well, we're saying here that the total cost should have been 4,600. So how close did we come? We came within $100. Then they ask you why. Why should there be a difference? And the answer is, well, without knowing more information, you really can't say, but there's a possibility that something cost more than you thought it did, right? Maybe for 1 month, maybe the cost of your materials was higher than preceding months. Maybe your labor costs were higher in 1 month than in the other months, right? These things happen. So I think that's what they were getting at. So that's exercise 5-7, the high-low method. The next one we had was exercise 17. Now, exercise 17, when you first look at it, you say, what the heck, how am I going to come up with all these numbers? Because if you look on page 245, exercise 17, Riverside makes one model of wooden canoe. Partial information for it is it follows. So notice they tell you to make 540 canoes. Your variable costs are $67,500. Your fixed costs are $150,000. Your total costs are $217,500. And then there's a lot of question marks. So how do we fill in those question marks? Okay, well, the first thing I would say is the fixed cost is the same regardless of how many canoes you make, right? So here they're telling you 540 canoes, 620 canoes, 780 canoes. The fixed costs are exactly the same. So just fill that number in. All right, now, what about down here where it's per unit? Well, the variable cost we can figure out, because if it cost us $67,500 divided by 540 canoes, that's $125 per canoe. And what do we know about variable costs? Remember the discussion on the preceding video about variable costs and fixed costs. As the level of production increases, see how it goes from 540 to 620 to 780? The variable costs increase. The fixed costs stay the same. But on a per unit basis, the variable costs stay the same while the fixed costs decrease. Right? So where does this $67,500 come from? It's $125 times 540 is $67,500. Where does this $77,500 come from? It's 620 canoes times $125 a canoe. Where does this $97,500 come from? It's 780 canoes times $125 a canoe. Right? So that's where the numbers come from. Now, what about the fixed cost? The fixed cost is the $150,000 divided by the number of canoes. So remember in the example in the textbook, the total fixed cost stays the same, but the more canoes we make, the unit fixed cost decreases. Right? So what's the total? $217,500 or $402.78 per canoe, right? For 620 canoes, what's the total? $227,500 or $366.94 a canoe. For 780 canoes, what's the total cost? $247,500 or $317.31 per canoe, right? And you can see down here, I did some of the math for you so you could see that. Part 2 to the question, identify 3 costs that would be fixed and 3 costs that would be variable. For fixed cost, I said factory rent, supervisor's salary, machine depreciation. For variable costs, direct materials, direct labor, indirect materials, right? I guess you could also say indirect labor. And then part 3, suppose they sell canoes for $500 a piece. What's the contribution margin per canoe? Well, if they sell a canoe for $500 and the variable cost is $125, right, that we calculated up here, 500 minus 125 is $375. The contribution margin is $375. What's the contribution margin ratio? It's the contribution margin over the selling price. So 375 over 500 is 75%. And here's just another way of looking at it. 75%. Part 4, next year they expect to sell 700 canoes. What would that income statement look like? So if they sell 700 canoes at $500 each, that's sales revenue of $350,000. The variable costs are $125 a canoe. So if they sell 700 canoes, that's $87,500. 350 minus 87,500 is 262,500. Right? Now you could calculate that number as well, because if the contribution margin is $375 a canoe, which we calculated up here, right? And we sell 700 canoes, that's 262,500. Minus the fixed costs of 150,000, the net operating income is 112,500. Right? So that's exercise 17. Exercise 23. Exercise 23 is asking us to prepare 2 income statements. One the old way, that's full absorption, right? And the new way, which is variable costing. So if we look at the problem, the following information pertains to the first year of operation for Crystal Cold Coolers. They give us a list. And they say, prepare the full absorption costing income statement with the variable costing income statement for the year. Right? So I would do the full absorption first because that's the one that you're most familiar with. Right? And they're saying that you sold 2,500 of these things, whatever they make, and their selling price is $350. So 350 times 2,500 is 875,000. Minus cost of goods sold. Now they give you a lot of unit amounts here. So what's cost of goods sold? It's direct materials, 80, direct labor, 60, variable overhead, which is 10, and fixed overhead, which is 75. Right? They give you those numbers. If I add those together and multiply it by 2,500 units sold, that comes out to $562,500. That gives you a gross profit or gross margin of $312,500. 875 minus 562.5, right, is $312,500. Less the non-manufacturing expenses, you've got variable selling expenses come out to $15 a unit sold times 2,500 units sold is $37,500. And the administrative costs that are fixed is $65,000. That's a total of $102,500. And if I subtract, I wind up with a net operating income of $210,000. Now, variable costing. How's it going to be different? Well, sales revenue is the same, $350 a unit times 2,500 units sold is $875. Variable cost of goods sold. Now remember, we have to separate the cost between variable and fixed. So we have variable cost of goods sold being made up of direct materials of 80, direct labor of 60, and variable overhead of 10. So if I add those three together and multiply it by 2,500 units, it comes out to 375,000. I also have variable selling expenses. $15 a unit times 2,500 units sold is $37,500. That will give you a contribution margin of 462,500. Now, what are the fixed costs? The fixed costs are fixed overhead. The fixed overhead, and this was what made this a little bit tricky, right? Because if you compare the net income amounts, why are they different? Why shouldn't they be the same? This is the difference. The fixed overhead is based on how many units were made, not sold, how many units were made. We made 3,000 units. If you look at the chart on page 247, right? Number of units produced, 3,000 times $75 a unit. $75 a unit is $225,000. And then we had fixed administrative of 65,000. Gives you a net operating income of 172,500. And that, my friends, is chapter 5. Chapter 6 will be next.